over the next, several months and going into like the summer, I really want to be long risk. I'm looking at the big rejection of the Aussie dollar at 80 cents. That does concern me.
Well, hi, ladies and gentlemen. My name is Chris Weston. I'm head of research here at Pepperstone. I'm joined today by my good friend Blake Morrow. Blake Morrow is one of the business owners of FX Analytics, who we've got a partnership with, and it's been an absolutely crazy day on the markets. We'll go over the market moves, but I thought, no, who better to share and try and dissect the moves that have happened, everything that's happened from fixed income rates right through to the reverberations we've seen in equity into commodity markets and FX as well. And Blake's one of the sort of big FX guys around, so he's going to be able to help break down the move, give you some insight. But yeah, it's been a crazy day, so I thought it'd be a great idea just to sort of do a bit of impromptu webinar effectively with Blake, just to go over some of the market moves. So Blake, great to have you on board, buddy. How have you been? How's life at FX Analytics?
It's been great, and thanks for having me, Chris. Probably one of the best days to actually take a quick view of the market. Volatility had been so low as of late. I was hoping something would actually jolt the market a little bit, and it looks like the move in bonds globally after Jay Powell wrapped up his second day of testimony. It looks like it feels like the market's kind of calling him out now, doesn't it?
Right, basically, I just want to jump in, mate, because that's a great point. We sort of talk about what's going on at business level, but what you should be able to see the Bloomberg screen that I've got here.
I can see it.
I've got some implied volatility measures, and if you have a look at the blue line, which is the move index, which looks at implied volatility across the US Treasury curve, and then we've got the orangey line, which is effectively 3-month implied volatility in 10-year swaps. So effectively what the volatility we're seeing in the swaps market. And you can see that's absolutely ballooning at the moment. And generally what we see is a situation where equity volatility, the VIX, which we offer to clients as well, is the white line there, and also FX volatility, which I've used the JP Morgan G10 or 1-month volatility, which has been very subdued, as you rightly point out. But generally, the rates market and the bond market, if we're seeing expected movement pick up there, will resonate in high volatility in equities and FX. And we're seeing that now, because look at this, it's absolutely exploding to the upside. So we've had these very sleepy conditions in FX markets, ranges have been tight, and now the bond market and the rates market is screaming out that we're going to get higher volatility playing through in that capacity. So yeah, I think it's just what I just wanted to point out, because I think it really feeds into what you're saying there. So yeah, it's a great time to be in markets. And you guys at FX Analytics, I mean, you must be churning out the ideas and having to change back and going from a positive to a sort of a more sort of neutral setting. So what's your view there?
Yeah, well, first and foremost, as far as volatility goes, this is going to. I always thought that 2021 would be the year of the FX market comeback and volatility. And as volatility picks up, in equities, when you start to see selling, it brings in two-way price action in the markets. People start thinking about central banks and what they're going to do. And with the push up in yields across the curve, even the short end today exploding. And that's happening not only in the US, but if you look at, what's happening in Australia, where you're at, I mean, we happen to be on the opposite ends of the earth, but bond yields are still moving nonetheless. And when rate expectations start to shift, or expectations of what central banks might do, it brings in great two-way price action. And look, as a trader, what we do, we thrive on two-way price action. I don't necessarily want the equity markets to go from 4,000 in the S&P down to 2,000. I would like to see it go from 4,000 to 3,500, back up to 3,800, back to 3,500, then to 3,200, then back. That gives us a lot of opportunity, and people start shifting, weaving, and bobbing in the markets, and that gives us as traders not only opportunities to buy and sell and make money, but it also gives more room for error. And that's the one thing that has been absent the last couple of years, is when volatility is low, you have to be very, very particular about the trades you're taking, and your timing's got to be nearly impeccable. And as you know, Chris, we're not all perfect timers. I'll be the first one to admit I've spent the last 25 years trying to figure out timing in the markets being a trader, and you know, it's hit or miss, but having the two-way price action gives us a little bit more flexibility on, you know, maybe fudging up a little bit, but as long as we're following a general trend, we'll be all right.
Yeah, I just want to touch on those moves on bonds, because there's going to be a few people out there who, you know, don't follow the bond market as closely out there. But I want to say today, or overnight in the US trading session, your day that's been, let's have a look at the what we call the belly of the curve, right? This is the 5 to 8 year part of the curve. I mean, we saw that absolutely explode higher here in fives, 22 basis points. There's nearly one rate hike being priced into that part of the curve. 3-year treasuries up somewhere like 18 basis points. That's a 5.7 standard deviation move. These fat tail events are becoming far more frequent, you know, and then we go into the 10-year, which of course is the sort of classic benchmark that everyone focuses on. And that's been selling off for a while. So yields have been sort of progressively moving higher through October, January, and then bang, up it goes last night. I personally think that we've actually seen, I think we're getting closer to a top. This 160 level is the earnings yield of the S&P. You know, if I'll bring up a quick chart here.
And I know I've made comments, and just for those of you that are listening in at home, I've made comments to Chris in person that he is like the Bloomberg king. I've spent years trying to figure out how to use Bloomberg and just toss up my hands, and you are truly excellent at it. So
thank you.
You guys are great.
I've been doing it since 1998. But so what you've got here is the earnings yield of the S&P. So this is the expected dividend yield of the earnings. So not what they're currently paying, but the consensus view going forward. And I think this is the sort of Rubicon that everyone was looking at. So the consensus dividend yield for the for the S&P, 1.56%. So you've got the 10-year Treasury now 1.51. So the idea that the 10-year Treasury, the benchmark that everyone looks at now would have a higher yield, nominal yield, than the expected dividend yield of the S&P. Some people say that's pretty significant. So whether or not we're getting to a high in yields is something that we're looking at. But you know,
yeah, well, you know, breaking that down further, Chris, I mean, you know, if you're a saver, and I mean, you've been forced by the Fed and every central bank to put your money to work elsewhere, you know, and not into bonds. You've been out of the bond market, you know, and you're priced out. And so now does this shift longer term investors from putting their money to work in growth or you know, technology or what have you, maybe even you know, some dividend stocks back into, you know, more of savings types of vehicles?
Yeah, I mean that's an interesting one, and I want to point out this as well, Blake. Before we go into some of the other charts that make, because I think this is all the talk at the moment. Have a look at this. This is the euro dollar market. So it's not just that bonds are moving up, and you know, if you go into what's happening, you are going to see mortgage rates in the US. So this represents a tightening of financial conditions. Have a look at the euro dollar future markets. This is a tradable interest rate market where people can express a view on expected interest rates. 23 basis points in the December 23 contract. So the market has nearly priced in one full rate hike in one day, in going into this sort of late 23, early 24 part. That is about as aggressive a repricing as we've seen for a long period of time. And the Fed, I'm just going to stop sharing because we'll go and have a look at some of your charts now. I think we've given that. Yep. But the thing for me now is that the Fed, what we've heard from Powell, we've heard from Richard Clarida, we've heard from Esther George, we've heard from John Williams twice. I can go on. There's been a cohesive message within the Federal Reserve that they're fine with higher yields. They're absolutely fine. It's better growth, vaccine rollouts, perhaps mortgage convexity hedging that's been taking place. But all these people out there, you know, which make a pretty compelling case that the backup in yields is going to hurt the Treasury, it's going to hurt the debt repayments that's going to come through. We're going to see yield curve control playing through. The Fed are not going to allow this to happen. Like, we've seen this whole week a whole plethora of different Fed speakers coming out, and they've welcomed the steepening in the curve. It's been game on. It's like green light, keep selling bonds, keep selling bonds. But the equity market, and I'm going to share the screen with you now because I want to, let's have a look at some of the charts that we've got. I know you're an FX man and you trade and you use real money there. But I want to have a look at the Nasdaq because the Nasdaq's a really interesting one now because it's back up in yields. The conventional wisdom is that the higher the yield, when you discount the cash flows for these businesses, the net present value is falling. At least that's the sort of theoretical view that we've all been taught in university and various factors. Yeah. Back up in yields, very bad for the perception of cash flows and what it means for the present value. But we've seen a bit of underperformance from small caps overnight. What's your view here on the Nasdaq? Because this is the ultimate one that obviously faces the headwinds from higher yields. What's your price action? What's your view on this, Frank?
I'm glad you brought this up, Chris. And first of all, I do want to say that before we move on, I try to put myself in the shoes of, well, always when I'm trading, I try to put myself in the shoes of somebody who's on the other side of the trade as me, or a trade that I'm looking to take. How's the person on the other side feeling right now, based on if they were long or short, and I'm looking to go short, maybe they're long, how would they feel? But I try to put myself in the shoes of Fed Chairman Powell or the other Federal Reserve presidents, and this could go for most central bank governors. You talk about low, for crying out loud. Yeah. But you watch the move in yields, and they've welcomed a move in yields, but this is a pretty aggressive move. So
it's very aggressive.
Yeah, I mean, I'm sure they were like, okay, it would have been nice if we would have seen this move over the course of the next 4 weeks, but to get in one day, they've got to be like, ooh, are we losing control here? But anyway, it's a whole different story. But going back to your question about the Nasdaq or the equity markets in general, a couple big developments have been kind of brewing. The underperformance of the tech names, which is, I'm a pretty old school guy trading. We probably started in the markets probably around the same time in the mid 90s. Late 90s, when you really start, getting out of the sales aspect and more into the analysis trading aspect of the markets. I always look at the Nasdaq and technology just in general as leadership. And when you start to see that leadership really diverge away from the rest of the market, that tends to suggest to me that we're going to start to see some weakness overall. When you start to see outperformance of maybe some bigger cap names or whatnot. So right now you can see the Nasdaq has really underperformed, and actually I could match it up against the S&P, where the S&P has actually done quite better, and I still think that they both have some downside, but the Nasdaq has come out of what we call an ascending wedge. An ascending wedge is they're bullish, but it is a reversal pattern by nature and by definition. So when you, like in this case, when we hit a new high above the trend line resistance or the wedge resistance, then we form this head and shoulder pattern. You can see it here. And this has been on our radar for weeks, actually. Once we came through the support right around the 13,500 level in the NASDAQ 100, that suggested to me that we're in trouble, and it's going to be trouble. I have some friends that when I pointed out on social media that Apple was breaking below its trend line, longer term trend line support. Also, you can see the head and shoulder here, and this was back in mid-February, or actually 2 weeks ago, because this is a 4-hour chart. So I had a friend that he messaged me, and I'm like, look, this is a shot across the bow with the market, with Apple starting to break down here. And it's not saying that we're impending a reversal lower, and that's another situation there. But we need to be on guard. And so now the NASDAQ's really starting to roll over. And I think the risk is, and let me get back over to the NASDAQ really quick. The NASDAQ actually takes out, these spike lows. And that means we would be trading at levels that we haven't seen since the beginning of the year, which can then turned the NASDAQ negative. And once you go negative on the year, now it starts to turn into more of a sentiment issue, right? And sentiment is, everybody talks about, the inflation genie, if inflation genie gets out of the bottle, it's hard to put back in. What's harder to put back in my experience, is when sentiment shifts in the markets. When you go from, hey, I'm buying every dip, to I'm selling every rally, and after a prolonged run higher of the last year, and you got a lot of people going, yeah, that's a lot of liquidity, but then sentiment starts to shift, and now you start to see, quite possibly a reversal with bigger implications in cross markets, and that's when it bleeds over into FX as well.
Are you a seller of rallies now? I mean, I just think central banks can come out and we've got fiscal that's going to be voted on very soon. How much of that's discounted into bond markets and global markets more likely, but price action is true, and this chart to me says we've definitely got to be a bit more on the cautious side at the moment.
Right, and I'm not I'm not in that camp yet, but I look at, there's a lot of FX charts that really have reached the boiling point. When I say overnight, this had been yesterday for you. And I'll just take you through just a couple, because it's really important what I saw.
Yeah.
A few, and I'm going to pull up just a few charts.
You can say dollar CNH came up on your radar there.
It did, and that's one. Yeah. But I want to point out the Aussie, because I want to applaud you for being really just an Aussie, spot on Aussie bull for the last several months, and I mean you're just like spot on, right? The problem that I see with the Aussie that just happened yesterday is that we hit the 161%, which is a golden Fibonacci ratio. If there's like one Fibonacci ratio that I look at religiously, it's the 161% extension. That means something has gone way too far, and typically that my antenna's up at that point. If you take the move of the COVID move lower, that's from when we did a lockdown here in the US and everywhere else, we stretched out to the 161% extension. We failed thus far to take out the highs of 2018. I actually think that the Aussie dollar is going a lot higher, but I think right now, near term, when I say near term, I'm probably talking over the next few weeks, we might actually pull back to the.
Can you scroll in a bit more?
I'm sorry?
Can you scroll in a bit more?
In? Oh, yeah. I'll zoom in just a little bit here. After the outside day that we saw in the Aussie dollar, I'm actually looking at 78.20, which was the breakout point. And if we get below that, and you can see my little arrow here, that'll probably take us back to the mid 70, 76 cent level, maybe even lower. And that really, I hate to try to project too far, because it really depends on what copper is doing, which is another chart that really has my attention as well.
And copper's been going, rallied 110% from the March lows, and everyone's talking huge deficits of about 500,000 tons or whatever. It's huge deficits for this year. So the supply has been cut back, demand's picked up, and everyone's been buying. So
and everybody has been buying, and China's been paying above market value for copper as well. Look, I'm a copper bull. I'm an Aussie bull. I'm actually a dollar bear. But that doesn't mean that things are going to go up in a straight line or down in a straight line. And in copper's instance, we exceeded the 161% extension. I actually think we're going to slide back down below 4, probably back down to 380, 370, and then continue on higher.
I agree. I mean, the DSI on copper was, I think I saw one of your tweets.
93 for 4 days in a row. Today, I think it dropped back to 83, but when you see those high numbers for that extended period of time, it's like, it's like, okay, the rubber band has been stretched so far that it's probably going to snap back a little bit.
Yeah.
So that's a couple assets I'm looking at, or prices I was looking at. Also, the dollar Canadian, which happened to be my chart of the day that I post on our Forex Analytics blog.
Yeah.
It's the 127% extension of that same COVID spike higher move, which by the way, I think the dollar Canadian, is going to eventually have a double top and, drag us back down towards parity, not all the way to parity, I don't think, but, depending on how far inflation expectations tend to go over the next 1 to 2 years, we could, but that doesn't mean we can't bounce from where we're currently at around 126, 125, 126 back up to 130.
Yeah.
And so things I believe are a little exaggerated in one direction. And plus, I guess the one thing that I have been going back to this whole year, Chris, and you remember the end of last year, every analyst, every bank, I don't recall one bank end of year or 2021 forecast that wasn't a dollar bear, period. So
for sure.
There wasn't one. Maybe there was that I didn't see, but every report I read, they're all dollar bears. And they're probably going to be right, but everybody's on one side. It's a little lopsided. So, we might see some of that shake out. Now, the dollar CNH that you pointed out, that did pop up on the screen, I have it right here. We just took out a downtrend line. This is a weekly chart, right? So this
for me is like, we talk about the reflation trade that's gone through long copper, short duration assets, you're basically going into small caps, cyclical stocks, all these areas, Aussie dollar, Kiwi dollar, CAD, they've all been one circular trade. But for me, right at the heart of that is dollar CNH. You've seen the dollar weakening against the Chinese yuan. That's given Chinese importers purchasing power. It's made US goods cheaper. And, that's really been at the heart of that. So for me, there's been a really strong correlation between Aussie strength and Chinese yuan strength. And what we're now seeing is this as a leading indicator, in my opinion. So the yuan is starting to weaken. We've broken the trend, as you can rightly point out there. You're drawing some nice horizontal resistance coming through. Divergence. So yeah, I've always looked at this as one of the best or the most leading indicator looking charts that you can have, especially for some of these risk cyclical currencies like the Aussie Kiwi CAD. So yeah, I've got this on the radar. So I'm really glad you brought this up, because now we're starting to see a bit of kickback. What's the trade for you here, Blake? I'd personally be waiting for it just to smash through that ceiling. And then the question for me would be, looking at correlation analysis. If the Aussie still has a very strong correlation with the CNH, I'll just be looking for the cheapest spread. Do I want to go in Aussie dollar or do I want to go in dollar CNH? Aussie is going to be far cheaper to trade from a spread perspective, so you probably want to trade that, but you'd have dollar CNH as your leading indicator there.
Yeah, and I think I put that on correctly, but no, I didn't. Let me get rid of that really quick. I should have. I meant to click a box, but I didn't, so I'm going to do it right now. So Aussie US dollar, and let me put it over a new price scale. There we go. That'll show you that correlation that you're talking about. And this is the Aussie dollar. Down? Well, the Aussie dollar is the teal, right? Oh, I could put it upside down, but I like to. For me, I'm always looking at mirror images, I guess.
Right. Yeah.
That's because I stare at myself in the mirror all the time.
Oh, why wouldn't you? Why wouldn't you?
I'm joking. Okay, but when you're talking about the US dollar CNH, I tend not to trade it all that often. Right. And a lot of people will come back to me and they'll say, "Hey, Blake, it's a managed currency," and they but think about what China does here is they'll allow it to strengthen during the good times, but if you do start to see, or they start to feel that maybe that reflation trade is a little extended and you might start to see a reversal here, they're gonna try to actually manage and weaken their currency a little bit to offset some of the possible economic weakness that might be coming in the next few weeks, the next few months, or whatever the case may be. So that's why I tend not to trade it, but I do look at it like you. It's on the radar, and I agree with you. The Aussie, does this tell us that the Aussie might slump back down to the mid 70 cent level? Yeah, but man, that's going to give us some great opportunities probably going into the second half of 2021. Yep. Once stimulus really makes its way in. And remember, in the US, we're going to get massive infrastructure.
$5 trillion.
Yeah. it's going to be
$5 trillion you're going to get with the next relief bill, and then the infrastructure, which is going to be part paid by you, the taxpayer, over there. But no, seriously, I mean, I'm I'd be looking at any kind of pro risk positions right now, looking to hedge some of that exposure. I'll be looking, when we get a bit more clarity, this has got some legs, then I'd be looking to take advantage and probably trade more on the short side. But longer term, as part of a macro thesis, I think this is going to be a buying opportunity within a longer term bull trend. I think there's just going to be all the catalysts are there, that this is, the longer term bullish catalysts are in place. We may see some short-term gyrations because things have got a little bit extended, and that's, I think, what we're seeing some of the heat come out.
One last thing I wanted to bring up, and then I'm going to stop sharing my screen, and I know we probably are running close on time. The dollar Mexican peso, and you can actually pull up a chart of the rand as well.
Yeah.
The dollar Mexican peso though has built a great base over the last few months, and since like November-ish, this has been one of those trades that so many FX or portfolio managers, institutions have been really parked in, because they'll take the little higher yield that the Mexican peso will give, and over other currencies they'll be long Mex, and in a stock market environment that continues to go up, they'll just stay long Mex.
Yeah.
But what we've seen it actually base over the last several months where it should have been going down. Now you're probably going to get a situation where we get especially if risk aversion picks up a little bit from here, because yields are rising. JP Morgan put out a note yesterday about, hey, you got to reduce, your emerging market currency exposure based on rising yields. Sure. And then today, the dollar Mex busted through 2080, which was key double bottom support here.
Yeah.
We're going to probably take out the 200-day moving average, and we're probably going to trade back into the mid-20s again. And
I like that. Anything that builds a base and takes a long time to do it, that to me is a really strong situation. And then you break through, trend lines, you break through horizontal. I love that chart. I'm going to be sharing that with clients today. I think that looks really, really nice indeed. I think that the macro thesis is that high yields really bad, especially when real yields, inflation-adjusted yields are moving up. Yeah, I think dollar Mex could be a really good leading indicator for the EM space here. I think that's really good.
And it's going to be one of those situations too, Chris, that as a trader and a retail trader, we gotta be a little cognizant of like the rollover cost. So I think it's one of those that you try to pick up on dips intraday. You try to spin out of it after a day or two, because hanging on to the dollar Mexican peso longer term, you've really got to make a good net move to take away from some of the rollover costs that we incur as traders. So
let's quickly go. It's good call on the high bit on the high carry currencies. I want to go to two currencies. We'll smash them out really quickly. One is let's go into cable, because we're seeing a huge amount of flowing cable at the moment. So if you could just really share your screen again, that'd be good.
Oh yeah, sure. And by the way, I was thinking about you. I was out at the park with my son. He was playing some sports. Unlike where you're at, we don't have lockdowns. That's why we have such high COVID death rates, unfortunately. But it's crazy anyway. I want to point out that we had this big spike up in the cable the other night, and that happened in Asian trade. And that night I came back to our chat rooms, and it was obviously during your day. It was, I guess, yesterday, Thursday. Is it Thursday? Yeah. In your morning, I was like, hey, we may have seen the peak here, because we actually took out all these stops in the sterling over, in Asian trade when it was super thin. And now I'm looking at the cable after hitting the big 127% extension here, that it might be pulling back a little bit. I've been very constructive on sterling.
Yeah.
And I think I've been trying to play it against some crosses. One of the big charts that I've been following, just since we're talking about the sterling, is the euro sterling, but we also hit a multi-year trend line, and we plunged the stops through the 86 pence level. I think we're going back to 88, and so that's how I view technically the sterling. And what were your comments going to be here after such a great run?
Well, I mean, we've seen a massive repricing in the rates market. Negative rates have come off. Gilt yields have been moving higher in line with everything else there. But yeah, I think it just, again, there's so many of these sort of pro-risk currencies and pro-risk assets, which, the elastic band had pulled back, and we've seen this big repricing. I still sit in the camp that the pound's it's got some positive longer term catalysts coming through, but I think I'd be a bit cautious in the short term.
Can I show you? This is a weekly chart, and I'm pulling it back all the way to, I remember when the sterling, the cable traded 2008 above 2, and I remember when we were spiking up here. And you remember I was talking about the ascending wedge, and a descending wedge is a big reversal pattern too. And at post Brexit, once we sealed the agreement on the UK exit of the EU, that was in November, and we finally broke above that it's like over a decade long trend line. And so, like you, I'm extremely bullish the cable. I love it. I think it's made a really nice push, and to be honest, on what we see here, I think if we get a push back to the mid 130s, I'm going to be all over it to be on the long side, frankly.
Yeah. Euro sterling's another one we could have gone on, but let's just quickly go on to gold, and we'll wrap it up, because gold always gets a good look in. And I think for me, from a fundamental perspective, it's been a real hard one. We've got dollar eyes on that November swing, 1764. But you've seen real yields moving up. So inflation adjusted bond yields moving up, and gold has no yield. So gold worked incredibly well when we saw, real yields moving lower become ever deeper negative, because the fact that gold has no yield becomes a kind of quasi yield in itself. And that's where the store of value came in. But now yields are becoming less negative, and actually on a nominal basis moving up. So you can actually see that you're getting a higher expected return in the bond market. Energy stocks have been working well. Inflation expectations have been moving higher, but they're not really giving us the chance for an inflation scare. There's an opportunity cost of being in gold. Now, for me, the catalyst for gold bugs comes if the Fed at some stage come out and say that we're not happy with this move in bond yields, we want to cap it, and maybe they'd give us a pretty clear indication that they're going to do yield curve control at the long end. Where we're a million miles away from that, because the Fed have been welcoming this move in bond yields. But anything that suggests they're going to use their balance sheet more aggressively is where the gold market really kicks in. Or we see a situation where I think, the dollar was to fall somehow, but we don't see, such a move in yields. I think then maybe gold will rally. But at the moment, there's an opportunity. There has been an opportunity cost for being in gold, and that's why it's sort of been left for dead for some of the other commodities like lumber, copper, nickel, oil prices, for example. And so it's really been an opportunity cost. But yeah, what are you seeing? What are you seeing on the charts there?
Well, I think first of all, I think you bring up some great points about gold and about yield curve control, because and as you pointed out, we're probably a ways away from that happening. But the day that happens, you probably want to be long gold.
Yeah,
and then you want to be short the dollar.
The dollar
right?
will be getting absolutely creamed, and and gold will just go.
But where do we go between now and that?
Absolutely, yeah, we've got a lot of water to go under the bridge.
We do, and I look at, so gold has had this major support at the 7, and I'm looking obviously spot. So if you're looking at the front month futures, you might be looking at a slightly different price, but spot 1760, huge support. AB equals CD, bear flag pattern really points down towards 1680.
Right.
The 161% extension of this last move would take us down to 1640, which would be also previous channel support. So I think somewhere between the 1680 to 1640 level is where we're going. And as you pointed out, it's you probably, there's no real benefit to own gold at current for any macro type of reasons at this moment.
Right.
But
not if the dollar starts strengthening, as we potentially alluded to there. Blake, I'm going to wrap it up. Let's just as we're wrapping up, I want to hear in a nutshell, over the next 2 weeks, let's talk short term, although in FX markets, 4 hours is pretty short term these days. But
Yeah.
By way of your gut feel about sentiment and what you're seeing on price action, are you bearish, cautious? What's your overall stance here, and what market do you want to look at above everything else?
Well, I think, okay, first of all, I think because of the pivots that I've shown you in the markets, I would say I'm near-term bearish. Over the next, several months and going into like the summer, I really want to be long risk. I do. But between now and then, I'm looking at the big rejection of the Aussie dollar at 80 cents. That does concern me. I think that the NASDAQ looks susceptible to a nice decline. I do agree with you that the Fed will step in at some point. I always think that their radars go up probably around, once the equity markets have corrected over 10%, between that 10 to 20% threshold, you start to hear talk and chatter from different talking heads on Bloomberg and CNBC, and then the Fed starts, getting on their radar. But we're still a ways away from there. So I think near term, you could probably see risk pull back. You could see copper pull back. I think, some of these, gold, as we just pointed out, can pull back a little bit. Yeah. But the Aussie and maybe some of the Aussie crosses, but I do really want to be long, as I pointed out with you, I really want to be long sterling on a move lower. If we can get, pound dollar back to 135, 133, 136, somewhere in that neighborhood, depending on what's happening at that moment, those are going to be levels that I find it attractive.
Yeah, I'm on the same view. I mean, I think short-term cautious. I do think we're getting to a short-term peak in bond yields, and we may see some buying step in. These things tend to have this kind of big circle. We see bond yields going higher, equities going lower, the risk-off situation, bond yields, everyone catches a bid. So it's kind of this circling, but short-term pretty bearish. I love that dollar MEX chart. I think that looks really interesting. And I think this got some great upside, could be a leader. We'll have to see what happens with crude as well. Dollar CNH, watch that. But we're watching the bond market, watching vols, and just watching the repricing in this rates market, because the Fed can control this destiny, and they can come and step in at any stage and say, look, guys, you're getting ahead of yourself. Our commitment is to this, honor that. So, a bit cautious, but I think longer term, I'm same as you, nothing's really changed. The elastic band's been snapped. We're just coming back, a bit cautious in the short term. Longer term, those bullish catalysts are still there. So I think short term cautious, longer term, still very bullish on what's going on, and we'll just be using the pullback as a buying opportunity. But Blake, as always, great to have you on board. I think we've gone through a few different markets. We could have gone euro, dollar. We could have gone a load of other currencies, but there's always another time. And I wish you a good Thursday night over in Phoenix there. So stay well, my good friend.
Thank you. And I want to say, hey, Chris, thanks for having me, and hat tip to you, your calls, keeping the Pepperstone community, long Aussie dollars and long risk for the last several months has been the right call. You've done a great job. And I'm so glad that we at Forex Analytics have a partnership with you guys at Pepperstone. So thank you.
Yeah. So if there's any premium clients who are watching this and you haven't heard about Forex Analytics, we're not doing our job very well. We need to make sure that you're connected with these guys, speak to your account manager there about what's the benefits of being.
And we can get you on board immediately.
Cool. All right, Blake. Well, thanks very much, and I hope to check in very soon with you.
All right. Thanks, Chris. Have a great one.